Uh, Good afternoon, everyone. Welcome to the Grand Thornton webinar on Decoding Tax Returns 2023. We plan to discuss, so what's the topic all about? We said that, okay, we have the tax returns compliance season on. We essentially, everybody would be busy, trying to file their own corporate tax returns, partnership returns, of course, where the tax audit is compulsory. But having said that, we thought, okay, why is it that we should at least discuss this particular subject matter? And we said, tax return is no longer just filling in the numbers. It's no longer just, kind of taking positions. It's a lot more than that. And what is it? So we said, okay, let's look at it a little differently. Let's look at it from a different lens. And here we are. Today, what we're going to be talking about is essentially first, look at the overall ITR filing, which is in effect, it is aligning substance and form. We also talk about it's now no longer just filing your return and your financials. It's also broad basing of the tax base and ease of compliance or ease of doing business. We're going to be just somewhere touching upon that as well. Of course, consequences of non-compliance. And then we are going to be talking about what are the key takeaways. I will be joined by my renowned chartered accountants who are basically they're subject matter experts. Amit Kumar, who comes in with 23 years of, more than 23 years of post-qualification experience in corporate and international tax. He will also be joined by Chartered Accountant Aparna Khatri, who is again a subject matter expert on corporate, international tax, and transfer pricing. I'm Rajshri. I would essentially give you a flavor of what are some of the key, or basically just talking about what is it that we plan to talk about today. Return of income is no longer just, as I said, filling in the numbers. It is a document which essentially is your starting point for essentially, it gives you a sense of what is the statement of affairs for a particular corporate taxpayer. And I'm just saying corporate taxpayer, but please take it as it's for the taxpayer whose return due dates are by 31st of October and even otherwise. You have a very brief window for revising the return. If you recollect, earlier there was a certain timeline that was prescribed, which has again been kind of condensed to almost like just 9 months. There is clearly a lot being spoken about broad basing the tax base. There is also a lot being spoken about connecting the dots. When I say connecting the dots, it's connecting the dots, which is essentially whatever you disclose in your tax return, is it the same turnover that I've disclosed in my GST return? Have I missed out anything which has been reflected in my annual information statement? Or is it something that I've missed out, which is now currently being reflected in my 26 AS? 26 AS basically is your TDS annual document, or what I would say is a certificate, akin to a certificate, which is available on the tax portal of the department. Added to this is this entire process of now faceless assessments, because clearly the theme was maximum governance and compliance being a subset of governance. It is important in terms of what positions you are taking when you're filing this one document, which carries the signature of either your managing director or your CEO, basically the principal officer of the company. I definitely cannot take it lightly. And I would say, even today, if I have to be very clear on what a company is kind of evaluating or talking about, I would want to see what's there in the return, because it essentially gives a sense of Am I taking the correct position? Have I been impacted by any decisions which have been pronounced in the recent past, which may have an impact on how I'm disclosing my taxes? Am I being impacted by any changes that are taking place in the global world today, which essentially kind of makes it compulsory for me to take a look at, am I being impacted? Any of my subsidiaries, any of my branches overseas? Of course, subsidiary really doesn't matter too much, not much, because we still don't have group consolidation, at least for tax purposes. Branches, is there a distinction? Is there something that I need to take care of, changes in a particular jurisdiction, which may have an impact on how I disclose my income in the current year? So with this theme in mind, and as I said, this is one document which I place the DSC of my principal officer. So I very well be careful in terms of what is it that I am stating? Why is it that I'm stating what I'm stating? Including, have I really kind of captured what key positions I'm adopting when I am filing this tax return? Why? Because now it is a faceless assessment proceeding, faceless appeals wherever applicable. So there is a very, the ability for you to actually explain your business case is very limited. So maximum disclosure, minimum interaction, maximum compliance, maximum governance. With that theme, I would now request CA Aparna Khatri to actually cover the first topic, which is essentially some of the key changes that have taken place in the new form, in ITR, the filing form, and aligning substance and form, i.e. linking, to a large extent, what positions you've taken. I would now hand it over to Aparna. Aparna?
Thank you so much, Rashri, and a very warm good afternoon to everyone. Before I begin, I would really like to thank everyone for taking time off their already packed calendars. We are conscious of the fact that we are sitting on 26th October, and everyone must be having a lot to do. And the participation here is just a testimony of the importance of this discussion, as Rashri mentioned. So what we have tried to do here and why we are doing this discussion today, I just thought I'll speak a minute on it. So we all are aware that Budget 2023 had very little big bang announcements, very little change in the fine text as well, thankfully. So when we started this entire compliance process season, we thought that, it would be business as usual. More or less, the stance taken for FY22 would kind of spill over into 23. We'd like to talk to people around, educate, discuss new issues that will come up, but we thought maybe for this year, those will be far and few, considering that the budget was not such a big event. Over the course, as we were doing interactions with our teams across locations, we realized that there were certain points which still are a cause of worry. And those points are agnostic to industry, agnostic to location. So those are issues which filers are facing, be it individuals, be it corporates, be it LLPs and otherwise. Of course, the theme today is more focused on corporates. So we will kind of curtail our discussion to only corporates and focus more on ITR 6. The idea here was that whatever learnings we gained over all those interactions is to kind of, disseminate to larger set of people. So the idea is to contribute in whatever small way we can to the compliance process. And if we can help you, set some things right and avoid those notices, those defects to the extent possible, it would be a win-win for us. Also, Amit will touch upon the nuances of the different filings. My focus will be more on the forms and some areas where typically you tend to miss out. The idea is not to cover the entire laundry list. We have picked up a few selective topics, and also we were trying to cover both residents and non-residents. So maybe you will not find the entire array of issues in the deck, but there are some areas which we feel are left out, or because it may not have an impact on the actual income computation, tax payments, so on and so forth. They are generally missed. And when you actually start filling the form and you start validating it, is when you realize that, oh, we should have done this sooner than later. And then there is that last minute panic. So we would sharing our experiences here. Question answers, we will take it at the end. The first slide, and this is more from a coverage point of view because we wanted to just cover this point. Not really too many changes in the ITR 6 for this year. Also because of the fact that budget was not, there weren't too many changes in the budget. The first two bullets talk about the change in ITR 6 pursuant to the change in the budget or the substantive changes. The other four are more or less procedural changes, or where they have tried to correct the form or correct it in line with what was already there in the act. The first point is in the context of the introduction of Schedule VDA. So as we are aware from this year, if you have income from transfer of virtual digital assets, the same is taxable. And they have made changes to the form at various places. So there is a new Schedule VDA, which is inserted, where you have to give details of the virtual digital assets when you acquired them, the disposal details, cost of acquisition, the gain, so on and so forth. Also, the stance that you take, whether it is business income or capital gains, will decide whether you report it in which of the sections. Also, because it is income which is taxable at special rates, so there are changes in SI, there is change in total income. So if you have those kind of transactions, there are various schedules which you will need to be mindful of when you are filling your tax return. The second change is in the context of the removal of the beneficial or the concessional tax rate of 15% when there is income earned by an Indian company from a foreign subsidiary where you are holding a stake of more than 26%. After DDT abolishment or after DDT was put out, they are trying to align the tax rates for dividends from Indian subsidiaries versus overseas. So now the section is no more there. Accordingly, whatever references to 115 BBD were there in the form have been removed. There is a very specific change in the context of 153C related returns, which you have to file where there were searches in other cases. It was removed in the previous year, but I believe that because there could be search cases which would have an impact in the case of other assessees for AY 23-24 as well, they have now reintroduced this option of filing the return under 153C. The next change is more of a procedural one. They realize that a company cannot have a self-occupied property, so that option has been dropped. The change with respect to donation, and assuming you are an entity who is still in the old regime and you are capable of or eligible of claiming ATG deduction, there is a change in the form now, and basically the intent here is to have more information to avoid round tripping of funds within corporates or within entities in India itself in the garb of donations. So wherever you have a donation which is eligible for the 50% deduction, of course, subject to your total income eligibility, you have to give the donation reference number as well in the form. The last change that we have captured here is in the context of TCS credit. So when you are filing your tax return and when CPC is validating it or verifying it with the form 26AS, there could be a case where there is a TCS credit which is appearing in your form 26AS which does not belong to you. So like the option that was already there in place for TDS, they have now even activated this for TCS. So if the TCS belongs to some other person, then you can state so in the return itself. So it helps you to avoid all the verification or the CPC questions or the 143(1) issues that will come up because of the non-reconciliation or because of the disconnect in the ITR 6 versus the form 26AS. So this is by and large the key changes that are there in form ITR 6. There are others, but very small ones, not really worth people's time over here. So we are just covering these aspects here. The next change, we just picked up a few very select topics to discuss here, and one of them was the the experience that we gained when we were doing compliances for non-resident companies. As we all know that typically we have most of the investments coming in from treaty jurisdictions, and most of the payments are eligible for DTAA rates. Often the question arises is whether these companies need to file a tax return in India, which means that they need to apply for a PAN. And I'm keeping the 10F issues and everything aside for now. Question is whether do I really need to file a tax return because I am not taxable pursuant to the DTAA. If that be the case, where you are saying it's business income, no P, no tax. So in those kind of cases, that question arises. By and large, the position that is there today is that unless you have a protection under Section 115A of the Act, you ought to file your tax returns. This is coming from the provisions of the Act, also from AR rulings. The mandate is that let the AO decide the eligibility, and you have to do the compliance as a measure of your operating in India or you having any income from India. Also, after the BEPS action plans, there is a lot of emphasis which we are seeing on substance and saying principal purpose test, so on and so forth. In those cases as well, it is the AO who has to evaluate whether you are eligible for the treaty benefits, and all that can be done only once you file the tax return. So yes, the answer to this would in most cases be that you should file your tax return. The other piece is, okay, I have decided to file my tax return. I have a screen lock actually. You can hear me? I have a screen lock. Okay. Sorry, I'm facing some technical issue. I will continue talking. So the other issue that we face is, okay, we've decided to file the tax return. What do we report? Because generally the impression is that where you have nil taxable income in India, pursuant to the fact that you are characterizing the income as business income, no P, no tax, you will feel that it's a nil return. I really don't need to focus a lot on the filing process. I only need to claim refund for taxes because generally the customer would have withheld taxes in most cases. And the idea of filing the tax return is to claim the refund. What we generally see people missing out on is there are some details which need to be explicitly filled in the form, even though it may not impact your taxable income. It is an ask of the form. Also from a reporting best practice perspective, it is important that you disclose these streams of income. So we have taken, for example, Schedule EI, which deals with exempt income, and that has, we've just taken a snapshot of the relevant part of the table. If you see the top part, it refers to the income which is exempt, okay, and the bottom part refers to income which is not taxable pursuant to the DTAA. If you are claiming exemption under the DTAA, then you will report it in clause 4. There are many instances where your income, say for example, you are distributing some kind of software and you have done an analysis, you have come to a conclusion, this is not royalty, this is not FTS, you don't have a P in India, but under the equalization levy, this transaction could be subject to equalization levy, so you have to pay the 2% tax. Under the Income Tax Act, if you have paid EQL or equalization levy, then you can claim exemption for the said income under Section 1050 of the Act. And that is where Table 3 will get triggered, and you will need to report the income therein in 3B. So where you can specify that you are claiming a tax exemption for the same. There is also another table. I don't have a screenshot here. I didn't want the slide to get very heavy, but also there's another Schedule OS. So please look at the character of income. Schedule OS requires you to report the income which are taxable under those specific rates. And there is a table in the same schedule where you also have to report income which is exempt under DTAA, or it is taxable at a different rate under DTAA. So please do have a look at the Schedule OS as well and see where your relevant stream of income will fall. This was more relating to the taxability aspect or a position taken with respect to the DTAA. The other aspect that is of relevance here, and we really saw some struggle on this when this was introduced last year. And actually, when we were filing the income last year, during the process, we saw this clause changing from you could fill to a mandatory field. So when we started the return filing process, we thought maybe, this clause could be skipped, especially where our client was claiming a DTAA protection. So really SCP or significant economic presence is not of much consequence. But as we progressed and as the due date came closer, this clause was made mandatory because of the utility updates. So the idea was very clear. The government was very clear. Whether you claim treaty protection or otherwise, you have to do the necessary reporting. Generally, what people take a stance is SCP comes into play only when I am coming from a non-treaty country. So really, this is of no consequence. But because of this form, you really need to report it. You need to take stock of the revenues that you want to show that are arising from India. This should be aligned to the revenues or reconciled with the revenues which are reported under your other schedules. Also, there is a specific ask in this schedule with respect to number of users. There is no specific guidance in terms of how do you compute the number of users. And so there were a lot of questions, we are looking at a span of 12 months and we know digital business, the number of subscribers keep changing very often. It could change during the course of a single day. I may subscribe, I may unsubscribe, I may renew my subscription, so on and so forth. So it's a very, very dynamic number. So what do we do? Do we take the year-end number? Do we take the start of the year number? Do we do an average of the months? You take the highest number of users. Whatever stance you take, please document the rationale for the same is what we are trying to say here. And the other thing is to start this process early because this is the data which will not be easily available to the tax team. So this was the coverage with respect to foreign players who have some kind of income source in India. The next issue that we will be covering is the typically missed out areas. And here we wanted to capture two schedules. Maybe AL1, which is on the right side, is generally filled, not so much of an issue. But yes, it is a reporting requirement. One may feel that, it really does not impact my TTI, my schedule where I'm reporting my income. But there is a specific ask and this table needs to be filled. Of course, if you have business income and you're already reporting it in balance sheet elsewhere, then you can take a stance that you don't need to report it here. But yes, please look at the various assets that you have. Look at the classification because this is a table in itself. There is a very, very specific ask in this table. We need to focus on what is the ask of the table. And this is asking you to file the data as on the year end. So it is asking you to file data as on 31st of March 23 for the current year. So AL1 is less of an issue because it is more or less aligned with the balance sheet that you prepare. But the idea is that people may miss out. So we've covered it over here. The one which is more draconian in that sense, if I may use that adjective, is Schedule FA. Schedule FA is and we've seen a lot of action on the front where individuals and all were concerned. The idea is that the government wants to compile data with respect to any foreign assets or income from any sources which are outside India. The applicability is wide. So there are various tables in this schedule also. You should look at those. It is not only restricted to assets that you own. It is also, for example, for individuals, maybe not relevant over here where you are a signatory, you have an insurance policy, so on and so forth. So the coverage of this schedule is very, very wide. We need to go through each clause and ensure that we are reporting. Second thing, which is very important over here is from last year, the schedule was earlier, it was aligned with the financial year reporting that we used to do. Now this schedule is aligned to calendar year. So you have to report assets, income sources for the calendar year. That is from January 22 to December 22. It requires you to undertake a reconciliation for the transactions which may be there in your financials for the financial year. Add the transactions for the first quarter, that is Jan to March 22. Subtract the transactions which are therein from January 23 to March 23. So this is an exercise which needs to be done. You need to maintain due reconciliations, what exchange rates you've applied. Rule 115 comes to your help. So please look at this schedule and please maintain the respective reconciliations. Very, very important. The other piece that we wanted to discuss here is why this is important from a reporting point of view is the penalties under this are not just restricted to the Income Tax Act. Non-reporting in this section has repercussions from a Black Money Act point of view also. Non-reporting 10 lakh, misreporting 10 lakh and so on and so forth. So please, you need to do the correct data collection, correct reporting, and please maintain the backup because this will not clearly just simply flow from your financial statements. The next point that we wanted to cover is typically we have a lot of Indian companies who are earning some kind of foreign source income. So you have players who are expanding. So there could be Indian MNCs who would have some subsidiaries outside India. So there could be brand royalties, there could be dividend income, there could be loans given to subsidiaries and various others. So there could be service income, so on and so forth. So whatever is the foreign sourced income and the tax which pertains to that has to be reported in FSI. So what we found is that there is a bit of disconnect between what is the position you take. So basically, when you look at Section 90, it says that the credit that you can avail or you are eligible for as FTC is restricted to the tax rate as provided in the relevant DTAA. So what it requires you to do is to do an country by country, item by item analysis of what is the income from that territory, what is the tax rate in India, what is the tax that has actually been deducted in that country, because that may not always be aligned to DTAA, and what is the tax rate which is there as per the relevant DTAA. FTC credit is a topic in itself and we can spend hours on it. But the point that we are trying to drive over here is the way the form is designed is you have to consolidate the various line items. So for example, if we take the table below, you have other sources. So dividend income and interest income, two different articles under the DTAA, two different rates. But you have to consolidate it and report it in the ITR. And sometimes this may give a different result as compared to the substantive application of the law. Say, for example, in a case where the foreign country has withheld taxes at a rate which is higher than the rates which are applicable to you. Let's look at a manufacturing entity who will be paying taxes at say 17%, but the withholding outside is maybe 20-25% for whatsoever reason. So when you consolidate this data, and we've done it in a few cases, the results are a little different as compared to what the law requires you to do. But so be it, you have to report your so please maintain backup of what we are putting over here in this table. And please, you need to do the analysis of what is the eligibility of FTC. And that is the calculation which you need to do. And you need to then take credit of the correct amount of taxes in the final schedule of TTI. So this table per se will not totally govern what is the right eligibility because of the consolidation that happens here. You will have to do that exercise separately. Another form which is to be filed along with the form FTC, for claiming foreign tax credit is form 67. This is a separate filing which the company needs to do. Thankfully, this is a little different from the ITR form. Here there is a proper segregation country-wise, income head-wise. So you can fill in more details over here. Till a year back, this form was supposed to be filed along with the return of income or by the due date of filing the return of income. There is some relaxation here now, and you can file this form now before end of the assessment year. There have been rulings where people have missed out to file this form, but they were eligible. The courts have taken a benevolent view. They have ruled in favor of the taxpayer. Not that we are suggesting anyway that you do not file the form or delay it. Any instance of non-compliance would result in litigation or any kind of additional cost trying to remedy the situation, which is not a very good space. So preferably file it with your return of income because the data is all available at that point of time. But having said that, if in case you miss out, you have time till end of the assessment year to fill this. We have seen challenges when filling FTC because of the very dynamic nature of the credit that we are taking. There could be misalignment or there could be a difference in the way taxes have been withheld when certificates are being made available to the Indian entity. Quantification, how they all reflected, so on and so forth. So very, very important that you do an analysis line by line of each item, document everything and maintain the backup, because at the stage of, you can file it along with the form 67, assuming there is a threshold, I believe, of 5 MB up to which you can upload. If you have more than that, then you can make a note and you can keep the documents ready to be filed with the assessing officer as and when the scrutiny is initiated. So best practice, keep everything ready as we get along. I'll just take another 5 minutes. The other piece which is associated with the foreign tax credit is what happens is if there is a lapse of credit or there is a loss of credit because of excess deduction done, or something which is more than the DTAA rate, or if say maybe I have a loss, I'm not eligible to claim the FTC, or maybe I have income where I have some kind of tax holiday and maybe my taxes are lesser, I'm not able to completely exhaust the FTC. So there are rulings, and of course you need to evaluate whether it is applicable in your case, and depending on the underlying taxes for which you are claiming the tax credit, where there is a discussion around whether the lapse or the taxes which are ineligible for FTC, whether they can qualify for a deduction under section 37(1), being in the nature of business expense in general. Whether we have ability to revise this, yes, we do. And actually we tried it in one case and we found that the old form 67 kind of just disappeared and it was replaced. So it's a replacement, unlike in other forms where you have your original form and you also can see the revised form. So wherever you have a plan of revising this, please ensure that you keep printouts, copies, everything of or digital copies of whatever has been uploaded in the first case. And because this form will get replaced. The last, so I think I will have list down. So basically the discussion here is in the context, and I'll just take a minute here. The discussion here is in the context of applicability of the act in substance versus what the form allows you to do. The Income Tax Act segregates income under 5 heads. So we have salary, we have income from house property, we have business income, we have capital gains, we have income from other sources. Depending on the business of the taxpayer, the objective, the articles of association, whatever stance the taxpayer takes, that this is my business activity, to something which could be interest for a normal manufacturer, and that interest could be income from other sources for that manufacturer, could for a holding company, say, be a normal business income. So, or say, for example, you have house property income. For a real estate developer, that could be business as usual, not really income under the head house property, depending on the stance that that person takes. Or you have dividend income where you are a holding company and you are in the business, or you are a holding company who is kind of expanding or holding companies, and your business is of such nature. Then for you, that although the said income could technically fall under a different head, but on principles, it is emanating from a business that you are undertaking and should be treated as business profits or business income. So there is a disconnect in the form when you have set off of losses, because there is a limitation in the form where you cannot set off the losses against different heads of income, where you have business income against HP, or say, for example, the income from other sources. So without getting into the form technicalities, there are some rulings we wanted to highlight over here, where the courts have upheld the supremacy of the act, and they have said that what you need to look at is what the provisions of the act are. If the income is in the nature of business income, then you ignore the heads of income and you look at what the true character of that income is. So there are some rulings which we have cited here. It could be in the context of income from house property or interest income or dividend income, where the courts have blessed the approach taken by the taxpayer. In these years, these are the older years where you were allowed to do a physical filing of the return. So it was more of a question or a challenge at the stage when you were picked up for scrutiny. Right now, there is a challenge because under Rule 12, you're mandatorily required to e-file your return. And there is a challenge in terms of offsetting the numbers when you go to set off the losses. We have seen in a few cases where people have approached the High Court saying that it's a technical challenge and it is not in consonance with the provisions of the Act, and the courts have granted relief. So if you are faced with a situation like this, we are yet to see CBD to come up with changes in the form. So there will be a challenge, and maybe recourse to, or some legal recourse is the only way to remedy the situation. I will just spend 2 minutes here. We just thought we'll pick up a few case studies. And I will actually just pick 2 because of time. So the second case study is, and these are the practical challenges that we saw. So case study 2 is more, say, for example, you have the due date for filing the return of income original is 31st October. and where there is TP 30th November. And the window to revise the return is very, very short. Say 1 month. By 31st December 2022, 23, you need to file your revised return. What if you come across some correction which you need to do after that? So there is this concept of updated return under section 139(8)(a), which allows you to file an updated return, but it comes with a lot of conditions. And what we saw practically when we were filling that form is that although you are actually offering an additional income to tax, or you are reducing your loss, you are trying to remedy an incorrect reporting in the past, but the way the form is designed, it actually, unless you are paying, you end up paying some form of taxes, you will face a validation error. So let us not just be complacent that, okay, we missed the bus, we did not file the original return, we did not revise the return, we will file it in the updated return. At the end of the day, we are offering more. There is a challenge in terms of the practical implementation of this regulation, because unless you are paying a tax, submitting details of the taxes paid, you will face a challenge when uploading the return. So you should be mindful of those aspects. The last one which we wanted to cover was mismatch in TDS accrual by the vendor. So say you are the person in whose name TDS has been tax has been deducted. You have on accrual basis accounted for that income in your books as on 31st of March 23. The vendor has paid the taxes in the subsequent year and shown it as a FY 23-24 transaction. To match income with TDS, you will want to offer that TDS or claim credit for the TDS, although it is not appearing in the Form 26 AS for 2022-23 in the return for this year. So there was an amendment in the Act which allows you now to claim this credit. There is a specific form which you can file, and this provision is effective from 1st of October. So just a couple of weeks back, is just this month that it has been made effective. There is a separate form that you need to file, e-file, and claim the credit. We tried doing it. I think the form has been notified, but the e-filing is not yet been activated. So watch out for this if you have at least the past 2 years, because this allows you to claim credit for up to 2 years from the end of the year in which the taxes have actually been paid by the customer. So for up to 2 years, you can go back, and whenever this portal is active or whenever this utility is active, is allowing you to file the form, you can make the necessary filings. So this is what I would like to cover, and I will hand it over to Amit now to take on the next.
Sure, Aparna. Thank you very much. I think so. In the interest of time, we have 15-20 minutes. And this is the next topic, which is actually very, very important, as Rashri mentioned at the start of the session itself, that return filing is no more just a number filing game. And with lots of expectation coming from authority, and particularly with the fact that the returns are being signed by the managing director or the principal officers of the company, it's very, very important to keep a track of everything what is being filed. But ever we get into a dichotomy of ease of doing business vis-a-vis the broad basing of tax. As we all know that Indian government's priority is always to provide a better ecosystem for ease of doing business in India. But at the same time, there is a need of broad basing the tax net, and that brings to a perfect balance between both of them, because multiple filings or multiple data source could lead into mismatches and therefore could create a complex or challenging situations, which could lead to a revenue audit at the end of the day. And it is very, very important that taxpayer needs carefully reconcile each of the data before lodging their tax return. If you talk about income tax return, it has evolved over a period of time. I am sure some of us may be recollecting it, filing a manual return with boxes of the TDS certificates going along with that. And with that, today we are coming with an electronic filing, which is much quicker for reconciling, much simpler to flag off the issues. And authority or CPC level, they have put algorithm at the back end, which is very easy for them to verify, reconcile, and raise the flags of the exceptional items. Wherever there's a mismatches, we've been seeing those exceptional items are coming as a part of notices to us, whether it is coming as a part of the return processing statement, which is 143.1 level, or it is coming with an additional clarification during the course of the revenue audit. Therefore, what is more important or inevitable for any taxpayer to A, verify all the data reported into multiple filings. We are not only filing one tax return. And if you recollect, the tax return is the last in the entire series of event, where all these filings happen much before the filing of tax return. And therefore, it is very, very important that A, you verify the return, verify the data, B, reconcile the data wherever there's a reconciliation required, and C, keep a proper audit trail for such reconciliation. In the next part of the kind of discussion today, we have kept it interplay between the tax return and multiple other important information, documents, clarifications, which is already available with the authority as and when they process a tax return. First, we took it tax audit report. Now, this is applicable to a certain set of the corporate or certain set of a taxpayer. But if you see, there are quite a few disclosure which is being done in the tax audit report. And nowadays, tax audit report is also an electronic filing. Now, Annexure 2 of the income tax return provides a detailed instructions of which are the columns, which are the areas which is coming from tax audit report. And it's very naturally for the authority just to pick up the mismatches and raise the issues in front of the taxpayer that things are not matching. What we did here is we tried to put it some of the clauses which we found it very relevant to most of the corporate taxpayers. And those are like section 43B disclosures. These are verbatim coming from tax audit report. At times it happens that because of the delay in the time, because tax audit report is generally over 30 days before the tax return filing, you may find some additional claim which has happened under 43B because they are linked with the date of filing return, not date of tax audit report. And the taxpayer may want to claim more expenditure which is under the section 43B proviso. But since the numbers will not match, it will throw up an error. Now, that doesn't mean that we should not claim. If there are a legitimate claim, one should claim, but one should keep that in mind that it is going to throw up some sort of a reconciliation issue or some thought of a notices from the authorities. Similarly, we have a kind of section of 3615A, which was a subject matter of discussion until recently, but now Supreme Court judgment has made it very, very clear that if it is an employee contribution, then the due date should be the due date prescribed in the law. Appropriate disclosure to this regard again needs to come into the tax audit report as well as in ITRs. There are quite a few allowances, disallowances, which is there in section 40, starting from delay in filing withholding tax compliances, or there's a short deduction of withholding tax, etc. All those kind of disclosure against needs to be properly put it into the tax return because this will leads to a mismatches and therefore leads to some sort of a reconciliation issue. And last but not the least is a depreciation, where a depreciation is more or less aligned to the books, more or less aligned to the tax audit report. But we have seen increasingly with the change of the goodwill depreciation and the IP depreciation, all those things are also coming up into a proper disclosures requirement. What we also try to put it up is what are the common issues we are facing, and few of the common issues which we have kept it towards the right side of the slide. Now, some of them are already there in the part of P&L account, like liability written back, bad debts recovered, etc. What are these issues? They come under a provision of section 41 and therefore required to be separately disclosed under tax audit report. Until this is okay. Now, when you start the ITR, the number needs to be reported in ITR as well, and they will straight away come into a return of income as an addition, without taking into cognizance that this amount has already been credited into a profit and loss account, and therefore it needs to be disclosed properly, otherwise this could lead to a double taxation. Similarly, there are issues like GST refunds, which is technically not a P&L item if it is recognized as an asset. That also needs to handle properly in the disclosure side of it. ICDS adjustment, we have seen increasingly there is a difference of reporting, and the authority at times get confused from where to pick up the data when they are processing the CPC at CPC level. And last but not the least is the 43B versus 48(7), that is unapproved gratuity fund versus approved gratuity fund. Now, all these issues may lead to a double taxation if they have not been properly reported in the tax return, and therefore due care has to be given when the return filing exercise is happening so that it does not lead into the double taxation. Under tax audit report, there are a few other things, and they're very interesting because they don't form part directly into the tax return. Say, for example, related party transactions. Those are important point. There are 269 ST requirement. These are also there in tax audit report, properly disclosed. They're not forming part of income tax returns, but authorities are picking data from here. And then appropriate questions are being asked during the course of revenue assessment, or penalty process are being begun if proper RPT disclosure has not been done. If there are loans or advances which has been given more than the prescribed limit in otherwise in bank and check, or if assessee or the taxpayer has not maintained proper documentation with regard to arm's length of related party transaction under 42. All these things are very important for people to keep a track, keep a tab on it before they upload or before they finalize their tax return.
So, Ahmed, what you're really saying is that related party, I mean, I'm just picking that up because that's always my favorite topic, because related party under 48(2)(b), if you see the definition is different. You see related party under Companies Act is different. You see related party under, I mean, of course, international tax, transfer pricing as per tax provisions, there, of course, it's different. So question really is, you may have a related party reporting in your financial statement. Technically, it may not be a related party under tax laws, but
Yes.
if it is there in your financials, and the fact that your financials form the base for you to upload your return, question is, am I clear in terms of before I upload that return of mine, it is clearly not a related party under tax laws. I need to do that check.
Absolutely.
And which is what Amit is trying to bring out here, saying that, clearly it's not just RPT under transfer pricing. You have to look at all these various other regulations as well.
And actually, on top of it, since we are talking on RPT, the disclosure in the tax audit report is a complete disclosure of all the transactions. And it is at the assessees and the management discretion to first determine whether they are at arm's length or not. While transfer pricing, international transaction, there is an external third party CA certificates which has to be put in. There is no such requirement when it comes to the domestic related party transaction. And therefore, again, it is a management responsibility to keep a complete track and documentation that all these related party, domestic related party, falls within the principle of arm's length before we conclude and close the return. Let's move further. We have also kept it interplay with few of the other forms, and they are very critical and important forms. Few of them are very welcoming, if you ask me, as a tax return preparer when we start preparing return for any corporate. There's a new concept which came a couple of years back called AIS, Annual Information System. This is available in the portal for any taxpayer. Now, what does this takes? It actually takes data from various third-party filings done by various third parties. It has the data of your revenue, which is taken from your GST return. It has data of your purchases, which is taking information from the GST return filed by the other parties. It has data of your income in the form of dividend, interest, etc., etc. Now, typically, the finance team are anyway taking care of the entire transaction, putting into the financials, auditors are auditing, etc., etc. But what we have seen is matching of AIS system or AIS information to the final information is very important. This becomes more important because it is a dynamic form. As I told, this form takes data from third party. So if there is any mistake in filing any return or any SFT or any GST return by your supplier, by your customers, by your vendors, that may have an impact on this form. And therefore, it is important for us to reconcile each and every data. And wherever we believe the wrong data has been reported by third party, go and reconcile them. Because otherwise, tomorrow authority will simply download and say, hey, AIS says XYZ amount is your revenue. You are showing a number which is lesser or higher than that. Please reconcile. Now, this is an important tool which we should look at it. Fortunately, today at return processing level, it's not matching one-on-one, but it is good to have a data reconciled before you lodge your return to be aware of any questions or query comes from the authority during the return processing or during the assessment process. The second data which we have seen is GST return. Now, some of this GST data is also appearing in AIS, but GST returns are anyway important disclosure under tax audit report. It is a disclosure required under income tax return as well. Therefore, the revenue and the expenditure reported under GST needs to be properly reconciled and kept it there. What Aparna also touched base is classification of income and expense. In GST data, all could be revenue, but here you may be classifying into various heads of income, and therefore that reconciliation is also important from a GST return vis-a-vis how the return of income is going through. Last 26 years, if you ask me last 10, 12 years, one of the best things which happened out of the tax return electronic process is Form 26 years. Now, as a taxpayer, I need not keep a track of the withholding tax certificate which comes from various vendors, keep reconciling it, and keep filing a copy of it with the tax authorities for claiming a credit. Now, 26 years is a document which is there in the portal, taking data from multiple quarterly TDS returns filed by various income payers to us. And therefore, it's a very handy document. But like any other things, at times this also create an issue because the number reported in 26 years is again reported by or filled in by third parties. And therefore, a proper reconciliation is required. There were challenges in terms of number not being reported there. Like Aparna took a example where income is taxed on accrual basis, but the withholding tax or TDS has happened in the subsequent period by the payer, and therefore there is a dichotomy between claim of credit. It could be reverse cases also, where withholding tax happen in year one on advances, and you are going to offer it for the subsequent year. Now, some of these problems have been sorted out in the last few years where authorities have enabled processes, authorities have enabled buttons into the returns where you can just go check, uncheck, and therefore claim it. But still, what we have seen in huge cases that at times the taxes has been withheld by your customers, but there is some reporting issue at their level and it's not appearing in 26 years. A dichotomy comes, should we claim this as in the return or not? Now, the cash 22 story is if you claim in your return and at the time of processing the return 26 years is not updated, you will not get the credit. On the reverse side, if you don't claim in your return and later on if it is updated in 26 years also, the authority tend to deny saying that you have never claimed in your return and hence we will not give you. These are the practical challenges which need to be explained before the assessing officer or which need to be explained before the CPC as the case may be to reconcile. To cut a long story short, these are the important forms and information which is already there with the tax authorities, with the taxpayer, and therefore all of them has to be reconciled, verified, proper audit trail should be kept before one is ready to file the tax return. Now, what happened after we file the tax return? If you go to the next slide, and these are few of the common challenges which we have kept it. I'll just keep it in very short. If we are not filing our return properly, if we're not filling up our return properly, there will be mismatches or unwanted error, which will lead to processing the return in an incorrect manner and lead to the tax demands. That's the first problem. Second problem, we have seen during the ITR processing phase also, at times the authorities are just issuing 143.1 without issuing a proper clarification in advance saying that here is the problem. And even though they issue, you reply them CPC mechanically, at times don't even understand or don't even get cognizance of all of them, and they simply process the not corrected return, which is creating again into mismatches and levy of the tax. And we have also noticed is quite a few 143.1 is coming now, where the return has already been picked up for revenue audit or scrutiny assessment. In those cases, you don't have a right to go for 154 as well. And you have to wait for the assessing officer to complete the faceless assessment, explain all these issues to them. And as again Rashri mentioned, in the current scheme of things with the faceless things, there is less representation, more governance, more compliance, and that could lead into much more confusion there. And we have also seen in assessment proceedings, the authorities are asking data which is there in the tax return, which is there in the tax audit report, may not necessarily been taken at the CPC level. Cases like CSR expenses versus an ATG claim, things like ESOP expenses. There have been cases where some of your customers have written their bad debts in their books and they put your name into their returns. Authority are simply coming and saying that customers have considered it as a bad debts and therefore you are no longer to required to pay them and you need to offer it for tax. So there are so much of dynamism which is coming in the tax domain, and therefore one needs to take care of all of them, keep a proper audit trail as I mentioned to continue with that. And if you don't do it, there are penalty provisions, there are penal provisions to do it. A non-disclosure could lead to a penalty. Uh, a wrong disclosure could lead to a penalty, and non-filing could lead to penalty. All those things are very, very important to be kept in mind. In the interest of time, Rashri, I'll just hand it over to you. I think so I've finished my point of it. And good to hear yours.
Thanks. Thanks, Amit. I think we've also tried to capture a slide which talks about consequences of non-compliance. I'm really not going to take this into detail simply because we've got, we're running short of time. But having said that, this is something which is available as a part of the PPT, and the PPT will be uploaded on the website. So what is important is, maybe can we just move on to the next slide? So what are the key takeaways, right? I mean, at the end of this session, we've heard Amit, we've heard Aparna, subject matter experts, in terms of where they have, basis their experience, they've shared, what are the practical challenges that one really is likely to face, or at least what steps one should take to ensure that this document is comprehensive. It kind of is, you know what you're filing, you know what is the risk you're taking, you know what positions you're taking. And when I say you, it's basically the company, right? So what are the key takeaways? I mean, if I were to look at this simply, plan and prepare, document, report some of the key positions, and of course, need for evolution of the tax function. Now, why do I say that? Gone are those days wherein you file the paper return, you go and file it with the tax office, and then you had the ability to go and revise the return. I mean, obviously, the time that was available to revise the return also was decent, adequate. But today, I think Aparna touched upon that. It is effectively, you file a return in October, I need to file a revised return by December. So it's not, so the key messaging is that, please, when you're filing the first original return itself, let it be 98% correct, if not 100%. Maybe 2% error, and that is something which you can correct in December, and that too for issues in terms of something which you have genuinely missed out. Having said that, so what is it that I would quickly do? I would always look at, have there been any developments on the legal front or on the procedural aspect? So simple. I mean, I know it's a very hot topic right now, this Supreme Court decision in terms of the MFN clause, right? Companies, I'm sure, would have taken positions, would have actually, offered their income subject to a particular rate of tax, basis taking benefit of the MFN clause. Rightly, wrongly, I don't think we are not commenting on that. But with the Supreme Court decision, given the fact that it is a law of the land today and our return is due next month or in the current month, as the case may be, what is it that I need to do? So, these are some of the aspects that I would always kind of take into consideration certain internal events. When I talk about internal events, essentially, do I have all the data that I am disclosing in my return? Is that all readily available, or do I have to kind of take a position right now, or say that, okay, let me not fight the battle on all fronts. Let me just take up one key issue which I need to take up with the department, which I need to take up with the tax office, which I legitimately believe that it is something which is available to us. I mean, that's our interpretation, but we do have our basis. And last but not the least, as I said, given the fact that it's all e-filing now, if depending on the size of the return, I would also use technology to a large extent, to a very large extent, I would say, as an enabler. And this is something which I have seen, it definitely helps. It benefits the taxpayer. So what is this tax analytic tool all about? Now, Grant Thornton, Bharat, we do have a tax analytics tool. And, I have seen chartered accountants, Amit and Aparna, use this, for their own internal work. So what I would do is I would request, Amit, if you can just touch upon what is this tool all about? How does this really help?
Sure, sure, Rashri. Actually, when I looked at this tool, the tool gives you three major benefits. A, it takes the data which is final data which is going to the tax authority, so there's no multiple versions, so there's no need for any updated version coming in. It reconcile the tax audit report and the tax return, throw up error where there are mismatches. As I told, that's first of the critical thing for to avoid any sort of return processing mistakes which is done by the CPC level. Second, it also gives a very good analysis of the various parameters from a tax perspective. We know that CFOs or the tax heads are anyway having a good control of their analysis of the financials data. But from a tax data perspective, it provides a good analysis of how things are being done over a period of time, not only year on year, but also within the same year, different parameters, or if it is a group of 10 companies, 15 companies, how the different companies are behaving on a various parameters. So analysis are the second key things. It gives very interactive dashboards of the analysis. And at the end of the day, it gives you very comprehensive reports, which can be then discussed to the board, etc. for doing that. Now, how did it help us when we were doing our client returns? Is basically it gives us a very heads up in the start of the period itself, start before lodging the return, that all the mismatches are being corrected. There is no human error when we are being uploading the return, and at the same time, it gives a good analysis of the return data. So I really found it very, very useful when we have been using it for our tax returns.
Thanks, Amit, for that. I've seen certain Q&A questions that are posted on the chat box, but before I go to that, does anybody have any other question, any clarification? Please feel free to post it in the chat, or if you would like to ask, I'm sure our Vaibhavi will help. But having said that, let's go to the chat box for the Q&A. I think the first... Okay. Dhaval has asked a question. What could be the options for the correction in 143.1 when scrutiny proceedings are ongoing? Amit, you'd like to take that?
Yeah, so this is one of the things which we have noticed. Typically, if a 143.1 comes up, you have an option to go for 154 and make an application to the CPC. But if the scrutiny proceedings are going on, that functionality is no longer there. So there are only two options which we have been suggesting or we have been doing. A, if the matter is, if the file has been transferred to the jurisdictional assessing officer, go and have a request to the jurisdictional assessing officer to look into 154. But very in most of the cases, that's the jurisdictional assessing officer will come and say, hey, the matter is open for scrutiny. Why don't you make your submission or additional submission before the faceless assessing officers? Now, this problem has occurred in this current year, and therefore, most of the cases, the letter has been filed before the assessing officer or before the faceless assessing officer, explaining all these pointers. And we hope to understand and we hope to see a good order coming from them where they will keep a recognition of all those things and pass a proper informed order when the faceless assessment is over. So to answer the question, today we have only one option. In effect, is go to the faceless assessing officer and make an appropriate clarification, though it is not in the show cause notice, though it is not in the inquiry list, but to go for that. Uh, at times, we suggest to file a CIT appeal also on a protective basis, just not to miss the timeline, because in case the assessing officer fails to kind of consider it, it should not lead into any sort of a tax liability, and therefore file a CIT appeal on a protective basis and withdraw that CIT appeal in case the assessing officer gives you a proper clarification. So that's the view which we can take.
Okay. Thanks for that, Aman. Aparna, what's your view on the MFN decision? Would you, as a taxpayer today, what would you advise your clients in terms of, would you evaluate, would you take a position in this return itself, or at least would you make a disclosure saying that you reserve the right? What would you do? You're on mute.
In fact, Rashi, just before this call, we were having a conversation with one of our colleagues, and in that case, so while we were also looking at it for our client, it also has a significant impact for that particular assessee, where the impact is running into number of years retro. And the question right now is, what do we do for the November returns? And because the law as it stands today, as it is a Supreme Court ruling, till there is, a further challenge to the decision, or there are discussions that there will be a larger bench and so on and so forth. So that will happen in the due course, and only, we can't crystal gaze. But the law as it is today is we have to follow Supreme Court. We can reserve the right to fall under the provisions of MFN as they should be, because treaty is intended to give protection. But the way the Supreme Court has read it, we have to follow that. Yes. So when we are filing the tax returns for this in this November or October, as the case may be, we will have to follow the ruling as it is, and we can make all the disclosures and we can make all the filings in the notes to keep the claim alive if there is any kind of a reversal in the future. But as of today, yes, we have to follow.
Sure. Thanks for that. The next question is, what should be the disallowance where TDS is deducted at 2% instead of 10%? How should be the reporting in TAR? Amit, I think you could take this one.
Yeah, so this is again a technical positions, and typically what most of us are taking, that proportionate disallowances should be there. That means it's assuming there is a withholding tax of 10% required, but you did 2%, then in effect 80% of the expenditure will fall into the disallowance category. And as and when the deduction are being done, or the kind of taxes has been paid, you can claim it as a deduction the subsequent year. So proportionate disallowances need to be reported both in tax audit report as well as in income tax return.
Sure, thanks. When should a suo motu TP adjustment be reported?
There is no specific clause there in the tax return for international transfer pricing. What typically we do it is, there is a clause for 48(2)(b), which says that any amount which is paid over and above the admissible limit of related party, and therefore we generally report suo motu TP adjustment into that. If it leads to any sort of a secondary transfer pricing adjustment, there's a separate disclosure in the tax return where you have to put the secondary transfer pricing adjustment.
Rashi, I think they're already at 4:10.
Okay. So there are a few other questions. There's one from Prasanna Kulkarni where it says this is on the SEP. Maybe this is the last question I'll take. It talks about whether further with reference to SEP, since the section is not clear about what transactions needs to be reported, it just says aggregate of payments arising from transaction. Can you provide any information that only sales to be reported? This too.
I'll take that, Rashi.
Yeah, okay.
So the intent of SEP was to catch hold of the digital players, but the way the entire section has been worded, it has far-reaching. Rashi, you're on mute. Okay, she's reading. Sorry. So the intent was, when it started, was to catch hold of, if I may use that phrase, of the digital players who kind of do not pay taxes in India because they do not have any physical presence. They are all operating from outside India. We all know this is consequent to the digital taxation and so on and so forth. Long story short, the idea was to catch hold of revenues that are not being taxed here. And also, as a consequence of that, they also wanted to know the number of users that you have. But the way the section has been worded, it is talking of any property, goods, services. It's very, very wide. And they have not really constrained the section to say that, only payments received or income or revenue. It is very, very widely worded. So, in fact, we were debating this a couple of weeks back with another colleague that should you even look at payments? Unfortunately, the way the section is worded, yes. But if you look at intent, it should be revenue. Whatever stance you take, please make due disclosures in the notes to return. So that is one of, for us, the way we file tax returns. Return of income, ITR 6 is just one side of the coin. The second side of the coin is the notes to return. Whatever stance we take in the return of income, the rationale, the logic, the interpretation, everything has to be documented in the notes to return. You may file it as you feel appropriate, ideally before when the proceedings start, at the start itself. So even if you take a stance that I will be reporting only revenue transactions in the SEP column, you have to justify it in your notes to return. So at least there is no allegation with respect to underreporting, misreporting that the tax office may take up.
Thank you. Thank you for that. So I think we're pretty much done with all the questions. There is one last question. Maybe we'll answer it. Okay, you can type the answer. Thank you very much for the participation. Thank you very much, Amit. Thanks, Aparna.